Okie dokie. There we go. Okay. Let's do this. Welcome everybody to today's webinar. My name is Erica Figueredo. I'm the marketing specialist here at Next Generation. And alongside me today, I have Rosh Wadera, the Director of Investor Relations at Upside Avenue. We're going to be getting into a pretty exciting conversation with you guys today. But before we get started, I just wanted to review some housekeeping items. So for the duration of today's webinar, everyone's going to be on mute. If you can, just please find your Zoom control panel. That's going to be on the bottom of your screen. And with that, I'd like you to focus on the chat box and the Q&A box. In the chat box, I would love for you guys to take a minute and introduce yourselves. Let us know why you're here and if there's anything specific you're looking to learn. And if not, just the Q&A. The Q&A is where you're going to ask any of your questions. And obviously, we'd love to hear from you. So a little bit about myself. I've been with the company for about 4 years now. I know you guys are used to seeing a familiar face that's not with us today. Our Director of Marketing and Sales, Brittany Melville, is moving on to another job opportunity at the end of the month. So I am going to be presenting on any webinars in her place. And obviously you guys will still see Scott Ritchie on some of our other webinars. And we may introduce another one of our reps as well into the mix. But for today, you got me. So normally I'm just doing the intro and kind of pushing things along, but I'm going to be doing a little bit more. So normally what I do is just a little bit about Next Generation. So Next Generation is a custodian and administrator for self-directed retirement plans. There are 2 arms of our business. There's Next Generation Services, which handles all of the back office administration, mandatory reporting, bookkeeping, etc., for all of our client accounts. And then we have Next Generation Trust Company, which is a licensed and chartered trust company located in Sioux Falls, South Dakota. And you know, that's pretty much the gist. In terms of what we don't do, which we need to make very, very obvious, we are not a bank, we're not a fiduciary, so we do not provide any tax, legal, or financial advice. And we also don't review the merits or legitimacy of any investment. So any information that you guys are provided on today's webinar is for educational purposes only. And we encourage everybody to consult with their professional and or trusted advisor prior to making any investments. So with that, I'm going to let Rosh introduce himself and tell us a little bit about what brings you here today. So Rosh, over to you.
Thanks, Erica. Yeah, just really excited to be here today. A little bit about me. My name is Rosh, and I'm Director of Investor Relations over at Upside Avenue. Upside Avenue is a crowd-funded multifamily REIT, so a real estate investment trust that owns apartment complexes all across the growing state of Texas. And particularly myself, prior to Upside Avenue, my experience was in real estate development, so prefabricated industrial and commercial buildings on the construction and development side, and then as well as investment banking in oil and gas. Naturally, being in Texas, everyone has spent a little bit of time in the oil and gas industry, but today is all about real estate. Really excited to be here. This presentation in specific, you know, is kind of, we put it together over at Upside Avenue. Number one is we just love mingling with the SDIRA crowd. The folks that I've met through the different SDIRA custodians across the country are all very intelligent, knowledgeable people. And it's always cool to, you know, speak with other folks that are taking their investments and retirement into their own hands. So this presentation in particular was meant more for the novice, you know, maybe no accounting or finance background. So we're looking at it from a high level. What are the key concepts that drive return on investment? And how can we, if we're faced with multiple deals, how can we distill it down to a few variables so we can more accurately compare and contrast one deal versus the other, and which is better for us?
Awesome. Thanks, Rosh. It sounds like we're going to be learning about a lot of really interesting things today. So to kick things off, why don't you tell us a little bit about cap rate?
Yeah, absolutely. And it naturally, it's not uncommon. Probably the first thing we'll jump into is this cap rate, short for capitalization rate. We have a formula here. Capitalization rate equals the net operating income. So in this case, we're talking about real estate. So it's that operating income of the asset. And let's just go back to that slide, divided by the purchase price. So that's the formula definition of capitalization rate. But I like to think of it more as, what question do we have and what does this formula answer for us? So if you notice, in calculating the capitalization rate, there's two variables that we have. We're taking one number and dividing it by the other. So the math is simple, but conceptually, what does it mean? It answers the first question, which is how much is it costing us? So that's there on the right. That's the purchase price. So for as much as it costs us to acquire this asset, to buy this property, how much cash flow is it getting back on a periodic basis? So how much does it cost us? And then for that price, how much cash flow are we getting out of it? Reason we'll distill it down to a percentage is because each asset has a different purchase price and each asset has a different cash flow. So to compare one asset over the other, we'll make it apples to apples and turn it into 1% and see, okay, which one has a higher capitalization rate, which is more likely what we want is the highest cap rate of one asset versus the other. So going on to that next slide, now that we kind of understand capitalization conceptually, for every dollar I put in, how many cents am I getting back in cash flow on a percentage basis? We just have a sample spreadsheet over here to help us, take a look at the calculation. Now, fortunately, in real estate, the financial statements don't get too complicated, at least in my opinion, compared to some operating businesses where they can get a little bit more complex. Because in real estate, it's fairly straightforward if we think about it, right? Regardless of which asset class you're investing in, whether it's retail, commercial, office, pretty much anything except for raw land, the income statement is going to follow a similar pattern. So there's no reason for anyone to get overwhelmed or confused by it if we understand, think of it as money coming in, and then for all that money that comes in, there are certain expenses that chip off of it. And then what you're left with at the end of the day is your cash flow. So in simplest terms, naturally, the money that comes in is the rent that we collect. So in operating businesses, we call this revenue. In real estate, we refer as to the rental income, but rent or revenue, whichever you call it, it's the money that the business collects, or in this case, the real estate, however often those periods are, more often than not on a monthly basis. And then you have all your expenses that chip off of that. So in this case, on this spreadsheet, we see here 17,000 a year is the revenue. So just, kind of arbitrary numbers we're using to fill the spreadsheet. And then we have all the expenses that come out of it. But key thing to note over here is we break up the expenses in two categories. You don't have to do it this way. This is not a GAAP accounting requirement or anything like that. It's just for us. It's nice to know of all the expenses we have, which are variable and which are fixed. And we'll talk more on that and why. But going back to the capitalization rate, we see over here on the bottom left where it says that the last row, my cash balance, 100,000 is how much we had invested to acquire this asset. And although it's collecting 17,000 in rent revenue, we're only left with, at the end of the day, for our operating income, 10,000. So in other words, we had 7,000 of expenses. So cap rate here, very easy numbers, 10,000, the operating income, divided by 100,000, what it cost us to acquire the asset, is 10%. So in other words, you're getting back 10 cents on every dollar you invested per year. So in 10 years, without accounting for the time value of money or any reinvestment, you get all your money back. But some other points on the next slide we'll discuss are, as I had mentioned, fixed versus variable. So, why is that important? Why do I feel the need to call that out? And why do we recommend other investors look into it? Is because of vacancies. In real estate, we're buying this cash flow. Unless you're doing rehab or a flip, we can talk on that later. But for our purposes, we're looking at a buy and hold strategy right here. And what we're buying is that cash flow. So naturally, one of the biggest risks we face in purchasing and investing in real estate are the risks of vacancies. Tenants don't live in there forever, although it's not uncommon, especially in the single triple net lease where you have 20, 30-year leases. But in multifamily residential, leases traditionally, let's just go for example's sake, a year long. So the tenant is going to leave, and there will take time to find the next tenant. So during that period, you have a vacancy. And this is why the fixed versus variable distinction on the expense profile comes into play, is because you may not have those variable expenses that you did, those expenses that are a function of revenue, like payment processing fees, for example, property management fees, but you'll still get hit with the fixed expenses like property tax or insurance. So it's important for us to know during a vacancy, what are the expenses, what are the fixed expenses that we'll be stuck with? And then, that way we get an idea of how much of a cash hole could we find ourselves in during those vacancies or during unexpected prolonged vacancies in particular. Another key point I just wanted to mention before we move on to the next slide is before or after taxes. So when I think in one of the prior slides, when we looked at the cap rate, it's up to you which way you want to do it. If you want to look at the cash flow before your taxes, or if you want to look at the cash flow after your taxes. My point here is just that whichever way you look at the cash flow to calculate your cap rate in the different investment opportunities you're considering, keep it consistent. So if in one you're looking at the cash flow after taxes, if in another you're looking at the cash flow before taxes and you're comparing the cap rates, you're not doing it right. And we don't want to make those mistakes. So going on.
Actually, before we move on, I wanted to ask a quick question. So
Yeah.
is the cap rate the same thing as the dividend rate?
Oh, okay. Wonderful question. Great question. So answer is no. Technically speaking, they're different numbers, but conceptually, they're both trying to tell you the same thing. It's just subtle accounting differences, which I'll explain.
Okay.
So the dividend yield is looking at, the amount of dividends I've received divided by the purchase price. So let's use stock of a REIT, for example, similar to Upside Avenue or any publicly traded REIT. I'm buying a share for, say, $10. And in the case of Upside Avenue, we had a 7.5% dividend yield. So that just means that for every $10 invested in that REIT, 75 cents was returned to you in dividends. So same thing conceptually, whereas the cap rate is again that same purchase price. So the $10 doesn't change, but the cash flow, we're just moving up the income statement. So instead of saying what the dividends were paid out, we're saying what was the operating income. And yes, for those folks that probably have a follow-up question or are fairly sharp, they say, well, what's the difference between the net operating income and the dividend cash flow? And the difference is the net operating income is the total cash flow from operations. From that cash flow received, some may then be used towards financing activities. Some of that cash flow may then be used towards reinvesting in the asset, rehabbing it. Whereas the dividend yield is after all of that, what's finally paid out. So in most cases, your dividend yield should be a lower rate, a lower percentage than the cap rate, because the cap rate is before certain investments and cash flows, whereas the dividend yield is after all of that. But conceptually, kind of trying to tell you the same thing. Well, great question, Erica.
Thanks. You definitely explained it very well. So hopefully that was clear for everyone else in the audience, but I think let's hop into a poll. So this poll that we have is specifically on cap rate. So let's get into that one.
Yeah, and while the folks are asking or answering this poll, I'll give some explanation here. You have option A on the left, option B on the right. So of these two options, which do you believe is better in terms of which one is producing a better well, I don't want to give the answer away, but for you as the investor, all else equal, presented with these two different investment opportunities, which is going to make you more money? What's going to make you wealthier?
I'll give everyone a couple more seconds on this. Okay, and let's share the results. So the majority of our audience said option B.
Okay,
is that
great.
Correct?
Yes, absolutely. So,
all right,
no surprise.
Let's explain that.
Yeah, and don't worry to my folks in the audience. We're gonna make it a little bit more challenging. We started off with an easy one, but I'm glad to see that almost every single person got that right. And if I'll explain this diagram, because we're going to use this same diagram on some of the later polls. The dark blue box is the kind of I think of it visually. It just helps me better understand, especially for the other visual learners out there, as kind of the dark blue box is the asset. And it has a purchase price on there. It's got the sticker. You see it's $100, and it's the same in both cases. The light blue box is, okay, you bought this asset. This is how much cash it turns out for you. This is how much operating income it pours out every year. So if both assets are costing us the same, but they have two different amounts of cash flow that they produce, naturally, again, assuming all else equal, there are some traps you can get into when you just go for the highest yield, and we'll discuss that later. But assuming all else equal, we want the one that pays us the most in cash flow, and that's option B on the right. $15 for every $100 we invested. In other words, 15%, clearly greater than the 10% on the left. So we got it right. We can move on.
Nice. And I think we have another poll coming up, so we'll get that one going too. So this Rosh is the same as the last one, just probably a little trickier.
Yeah, just a little bit trickier, but I have a feeling that the folks on this call are going to get it right. And again, we're assuming all else equal. I'll say one more thing before we look at the poll results. But one of the traps you might find, beware, is, especially starting out initially, I think everyone's kind of focused on yield. I mean, the other thing you can focus on is growth. So inevitably, all investors, fall into one of two camps. Do I want the income, or do I want the yield, or the growth? Fortunately, in real estate and REITs like Upside Avenue and all the other options you have out there, you can get both. But point I just wanted to mention is, be careful. A lot of times, the higher the yield, you're at a greater risk of losing, like a declining stock price. In terms of me in particular, I have a rental portfolio that I manage on behalf of a syndicate in Houston, and we're traditionally yield focused, but 9 out of 10 times the highest yield that's available, when I actually go out into that neighborhood, you'll see why it's selling for such a high yield. So just beware of things like that. But yeah, Erica, go ahead. What do we have here?
Let's see. We got 50-50 between A and B.
Okay, interesting. And you know what? That's actually the perfect response, because
okay.
So this,
are they both right?
Yeah, so basically everyone's right. And apologies, they told me don't get don't give too many trick questions, but I couldn't
It
help
was
it.
a trick question.
It, it was, and I wasn't supposed to do that, but I just wanted to drive in the point. And technically, everyone's right. Which is better, option A, option B? They're both the same. On the left, for every $100, we get $10, which on a percentage basis is 10%. On the right, for every $120, we get $12, which on a percentage basis is again 10%. So that's why we use the cap rate. Different purchase prices, different assets, different cash flow profiles. How do we compare one versus the other and equalize it down to this kind of a few variables?
Okay, so moving on, we're going to get into leverage, correct?
Yes.
All right,
Yes.
let's tell us a little bit about that.
Always a hot topic. Always a hot topic when it comes to leverage. Because, and I feel it's a contentious topic just because, you'll hear different things. Some folks say leverage is good, borrow as much as you can, just to acquire as many assets. And then you'll hear some other folks tell you, leverage is evil. It's the root of all evil. It'll crash the economy and bring it down. My personal opinion is that it falls somewhere in between. And I don't believe it's so binary that leverage is good or leverage is bad. I think it depends on the situation. I think it depends on the amounts of leverage. I think it depends on the cost of borrowing, things of that nature, as I'm sure all the folks in your audience are, maybe nodding their head like, yep, there's a lot more to it than, oh, it's good or it's bad. But point on this slide is we're looking at the spreadsheet and, there's many different ways that leverage enhances returns. Yes, it certainly does. All of the private equity funds use leverage, especially in the private markets. And who knows, maybe 99% of the real estate in America is purchased with a combination of borrowed money and equity. So how exactly, and this is geared for the novice, in my words, how exactly does it enhance returns? And kind of this is how I think about it using this spreadsheet is same numbers as last time, but this time where you see the net operating income on the bottom in bold, that's 7,500 every year. Remember, we're leaning more towards cash flow and income focused investments on this presentation. So if you notice, that number is lower than it was in one of the prior slides. We had 10,000. This time, though, we only have 7,500. So hang on a minute. We used leverage to acquire the asset, and it lowered our cash flow, technically speaking, because we have that additional expense of interest expense every year. In this case, it's 2,500. So how does that enhance our returns if we lowered our cash flow? Well, the answer is on the bottom over there. You see in the yellow highlighted row, our yield. So the cash flow as a percentage of the amount of cash we put in to acquire the asset went up from 10% to 15%. And the reason is because previously we put in 100 grand to acquire this asset. Now on the bottom here, you see that we put in 50,000 to acquire the asset because we borrowed the rest from the bank. That means that we have an additional expense now, the interest expense. That's how the bank makes money. So we have, yes, lower cash flow, but as a percent of the cash we put in to buy the asset, in terms of our yield. So every dollar we put in now, technically speaking, is yielding more than it did previously. So that's one way that leverage enhances our returns, and probably the most basic way I would explain it to my friends that are just starting out.
Okay, so I guess the popular question here is, based off of what you're telling us, how much leverage is too much?
Okay. Wonderful question. And, I would base it on some type of methodical calculation. So without getting into numbers or a specific formula, just to take a step back and look at it conceptually, there is such a thing, obviously, as too much leverage. So we see here it enhances our returns, but when are we overdoing it? And again, in my humble opinion, one of the first things I'll look at is how much has it decreased my cash flow? So if I borrow to acquire the asset, I'm going to be paying interest expense now. So I've increased my expenses, I've lowered my cash flow, but by how much? So if I've lowered my cash flow by 10%, I had $100 in cash every year it was producing, now it's only $90. That doesn't sound too bad. But if I've borrowed so much such that now my cash flow has been reduced from 100 before the use of leverage to now 30 or $25. Whoa, 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 whoa. Much of the cash flow that the asset generates is now going to the bank. So, the bank, we use the bank to help us acquire assets and acquire that cash flow at a higher yield. But if you borrow so much, after a certain point, the bank's making all the money off of it and not you. And that's where, hey, we're giving it too much leverage. So that does depend on the interest rates. We are in an environment where those interest rates are going up, which means the same amount of borrowings is going to have a higher expense, which means we won't be able to borrow as much as we used to going back. And that'll have an effect on the prices going forward.
Okay.
Another poll. Go ahead, Erica. Oh,
Is this a poll?
I think if we go back, we had a poll over there. Oh, yeah. So this is just visualizing it. You're right.
Yes.
Not a poll. So on the left is what we started with. On the right, now we're just putting it, into a visualization, how it increased our yield.
Okay.
Now, very important, we just have one slide just on this warning. So, it's just me being a little bit humorous, but kind of like anytime you borrow from the bank, there should be a big warning label on the loan that says, warning, increasing leverage also increases your exposure to risk. And risk is, especially if you get into academic finance, it's an interesting concept, the way that different folks define and look at risk. In our case, and in my opinion, in simplest terms, to define it to my nephew in middle school, it's basically the more you borrow, yes, it increases your return, but as much as it increases your return, you cannot fail to not acknowledge that it's also increasing your exposure to risk. So if you remember earlier, we were saying one of the biggest risks you face in real estate is unexpected or prolonged vacancies. The asset is not generating revenue anymore. You still have expenses, but you're not getting that revenue to offset those expenses. And the longer that vacancy occurs, which is a risk we all have to acknowledge and prepare for, even if it doesn't happen, we should be ready for it. The longer that vacancy occurs, the more likely the asset will drain whatever cash it had, to the point where you're having to put money back into it just to keep it going. Now remember, especially if we're focusing more on income-based investments, the whole purpose of investing is to make money, not to have to keep putting money back into it. But how does that go back into the risk is, if we use leverage, we have increased that expense profile, and the bank doesn't care if we have a vacancy. Mr. Bank's going to come and collect every month. He or she doesn't care whether or not you've got a vacancy, or even if COVID happened or anything like that. Mr. Bank wants his money. So in that case, had we not used any leverage, at least there's one less expense that we wouldn't have to worry about during those vacancies. And more importantly, no one can come at us and foreclose on us and take away this asset from us at a huge loss. So we can move on. I feel I've harped on that enough, but it's something that we always have to keep in mind, because we're all, for the most part, using leverage. So it can't be forgotten.
Of course
Some
not.
key point. Sorry, what'd you say?
I said, of course not.
Yeah. So just some key points. If you notice in our spreadsheets, when we were looking at the effective leverage, we were looking at the interest expense only. So on the residential space, especially in the single family, I know the mortgage payments are more often than not, they bundle your principal payback and your interest expense in one. In the commercial space, it's a little bit easier. More often than not, those loans are interest only. So my point here is just that if you're comparing two different assets and you're looking at the interest expense of those two different assets to determine its cash flow profile, just remember, if it's a mortgage in particular, part of that mortgage payment includes the principal payment. So you should actually back that out so that you're comparing just the interest expense versus just the interest expense. The principal payment, being forced to pay back a piece of the principal every month, it's tricky. On one hand, it's not a bad thing because it's just trading dollars for brick. So you're buying a little bit more equity into the home or the real estate property every month, which is a good thing because, better than just letting that cash sit idle, at least in the form of brick or concrete or wood or real estate. It should at a minimum be keeping up with inflation. But it also can be a little bit of a bad thing to be forced to require to pay back that principal because that's less cash flow you have available for reinvestment in higher returning assets possibly, or rather less cash flow you have available for the unexpected, such as our next point, the insurance deductible. So especially for the novices out there, the folks that are just starting out, most folks start out in the single family space with rental properties, unless you're a stock kind of guy or girl like me. But my point here is just in the expense profile, even in our own spreadsheet, you notice I didn't have anything with regards to the insurance deductible. But technically speaking, if some damage on the property occurs, let's hope that it's covered by the insurance policy. But even if it is covered by the insurance policy, we still have to pay a deductible. And especially in the commercial space, that amount can be really high. So if you get different opportunities with different sponsors, which I'm sure all of you are, different sponsors in different spaces that you can invest with, or even if you're doing it on your own, make sure that you have some plan or some cash budget to cover that deductible. I hope it doesn't occur and you don't need it, but should it occur, does the sponsor have any kind of plan? Are they going to come back to you and ask you for a capital call? And if so, did they make you aware of that, or did they themselves overlook it? Then that could be kind of a sign to help you better evaluate the different opportunities out there. So just another point, but we'll move on.
There we go. All right, tell us about liquidation.
This is actually more just a quick and easy, pointing out the obvious, and then we'll move on to the next one. Is just naturally, especially when you get more towards value add or even as immediate as just flipping the property, and this now pushes us more away from income and more towards growth is in the liquidation event, which is just another word for, hey, when we sell the property, we're not necessarily going to wait 10, 15 years to get all of our money back. We can sell and get our money back earlier. And obviously we're hoping to sell at a higher price. So let's move to the next slide. Actually, I'll show visually, in that liquidation event, leverage is working for us again. So going back to the question of, hey, how does leverage help us or enhance returns? This is the second time where it can come in handy for us. The first was when it lowered our cash flow profile, but that was okay because it increased our yield, to a certain extent that we're still able to pay all of our expenses and whatnot. Now, in the second event, leverage occurs for us. We're looking at it visually. Say you had the option A on the left, fairly straightforward. Dark blue box is the money that came out of our pocket. Dark gray is the bank's money. And then light blue is our money. So it increased our yield. But let's say while we're holding it, when we sell it on option B on the right, we get that green box, which is just showing the cash flow previously was 10 bucks. Now we've raised it to $12, whether it be through value add, rehab work, or just rising rents and population growth. For example, certain areas of Texas, just by the mere influx of population from coastal states, rents are going up. And so when the cash flow increases, naturally, that increases the investment value of the asset. So when we sell, we're selling it at a higher price. We're getting our money back, the dark blue box on the right, but we also get that green box, the $20 increase in value. And this is where leverage works for us because Mr. and Mrs. Bank, they just want their $50 back. So although they were giving us a hard time during the vacancies, when we sell, now they're showing being a little bit more friendly and giving us a good time because they say, all the excess over the loan value is yours to keep. I don't care. I just want the exact amount that I gave to you, whether it was 5, 10 years ago, the principal bank back, and whatever it may change while it's amortized. But point here is we get to keep the excess. So
Nice.
yep. Some key points, maintenance versus growth expenditures. So kind of going back to when we're looking at the expense profile of the asset, we should be careful, especially when it comes to maintenance on the asset, specify, or rather categorize for every type of maintenance or upgrade work we do on the asset. Is it a maintenance expense, to maintain the everyday operations, the status quo, so to repair faulty items? Or is it an upgrade to enhance the revenue generation potential of that asset? Reason is, especially when you get into the value add space, that's how a lot of folks will increase the cash flow profile, thereby increasing the investment value, thereby increasing your return on investment, and ultimately getting more money back into your pocket is through increasing that cash flow. So, quick way you can look at these different sponsors because there's a lot of folks out there, a lot of multifamily operators. You have a lot to choose from. Is just kind of ask yourself how much cash flow is derived from the asset as it is. So before we do any fix-up work, after we do any fix-up work, how much does that increase the cash flow? And that's another way that you can quick and easy back of the napkin calculation, try and measure some of the risks that's in this operation. So if I'm telling you, say I'm a sponsor and one of the many that you can choose from to invest your SDIRA dollars, and I say, hey, this complex or this office space producing $10 a month, and I tell you through some rehab, through some additional investment and upgrades, we can get it to $12 a month. Okay, so far sounds quite reasonable. We'll want to maybe look into it further. But if another guy or girl comes to you and says, hey, this is producing $10 a month, but I can get it to $18 a month. Well, now we take a step back. So you're going to increase the cash flow by 80%. Already off the bat, we can kind of quickly see that, okay, there's more risk in that. The more that we tie the bigger of a jump we require in the future cash flow to hit our target rate of return, the more risk we're taking on, because naturally there's no guarantee we can get it up 80%. But if I'm telling you we can go from $10 to $11, it doesn't sound too risky. It doesn't take as much to get to a 10% increase in cash flow. And another thing I just want to share from my personal experiences is especially with the operators out there, they may be able to increase cash flow. And or rather, let me put it this way. Ask yourself this, let me put it in a question, is does the market or does that area, does the population demographic, does the average income in that area, do they even have the ability or can they support to pay higher rents? So you could get a complex and think, oh, we can rehab this and we can really increase the cash flow. But even if you take a complex and you make it, class A, best of the best, brand new appliances, this and that, if it's in a certain area, folks may not pay a higher price. Even if it's a nicer unit in that area, they won't go above a certain price point. They'd rather just, live somewhere else if they're going to pay a higher price. That might be a little bit of a nicer area. So another one of the risks inherent in real estate investing.
Okay.
So again, I had mentioned earlier kind of two camps that I think most investors inevitably, as we go down this path of increasing our net worth, generating more wealth for ourselves and hopefully our community along the way. Most folks I feel will fall into one of two camps, either an income investor or a growth investor, or better yet, a combination of the two. You can get both in the same investment, but kind of especially on the income side, uh, you'll hear a lot. I want to buy something that's a discount to its intrinsic value, especially with the more professional investors and whatnot. They're running their numbers before they buy any asset. So no matter what the broker tells you what it's worth, no matter what price a multifamily sponsor is putting on investing in shares of their asset, every investor should have some idea of what it's worth on their own and independent of what the seller is telling you what it's worth. And if you can come to a conclusion on your own without having to do any deep financial modeling or getting a CPA license, but just having some idea that this asset is worth this, then you can compare that to the price it's being offered. And then you can know if you're getting a good deal or not. More importantly, you can know if you're being overcharged and avoid getting into bad deals with low rates of return or even losing money. So remember Warren Buffett's first two rules in investing. Number one is don't lose any money. Number two is don't forget rule number one. So so what I'm getting at here is valuation. It's very challenging to be an investor, to invest successfully, if you don't have some form or understanding of valuation on your own and apply that to the assets that you purchase. So we Google, hey, valuation, how do I value this asset or that asset? And you'll see over there in the bulleted list, income approach, rent multiplier, discounted cash flow, net present value, cap rate, we touched on earlier, sales comps, dividend discount model. Oh my goodness, so many options. This is too overwhelming. I can't do this. Well, hang on, take a step back, especially for my fellow novices out there. My time in investment banking, I spent 12 hours a day in an Excel financial modeling, doing all of these valuation methods. And one thing I realized is what it all comes down to is cash flow. So in simplest, what multiple are you paying of the asset's current cash flow? And naturally, the more cash flow you can acquire for a lower price, the higher yield you're getting, which then translates into a higher return on investment, which then translate into your net worth growing at a faster rate. But some folks get upset when I mention this. I don't know why. They say startups don't have any cash flow, but they clearly have value. VCs are investing in them. What do you say about that? It may not have cash flow right now. Take, for example, Uber or Lyft. They may not be profitable companies, but you see the Uber cars going around every neighborhood all across the country, now all across the world every day. And you yourself as a rider you see the cash flow coming out of your pocket and going to Uber. So clearly it's generating revenue. Now, it may be taking all the revenue that it generates and reinvesting it to grow faster and faster. But at some point in the future, it has the potential to produce a positive cash flow. And so that's what the VC investors are valuing it off of. So even in those cases where there's no cash flow today, just the potential to generate cash flow in the future is where that valuation comes from. So again, it comes down to that cash flow. Well, what about your house? People ask. And sometimes folks get upset with this when they find out that no, there's still cash flow. It's just not yours. And I'll explain. Say your primary residence, is more often than not valued on supply and demand, that auction process when it goes on the MLS, how many bids does it get? What are the comps from the homes down the street? So where's the cash flow in that valuation? I'll tell you, the folks that are making offers on that home, one of which will be accepted, which ultimately determines the valuation, which is then used to value the other homes. In order for them to make that offer, apart from the small sliver of society that's buying all cash, they first go to the bank, as you all know, mostly, everyone knows, and they see how much they're qualified for. And what is the bank looking at to see what you qualify for? They're looking at your income to see how much you qualify for. You are their cash flow. So again, it ties down to cash flow in one metric or the other. And if you go back to 06 or 07, before the crash in residential real estate, you could have looked at the prices of homes and the rate at which they were increasing versus the incomes of the folks across America and in the cities where the prices were rising the fastest. And if you see the price of the homes going up, but you don't see the incomes going up at a similar, more or less a similar rate, then inevitably it's going to do what? Crash back down. And so even in the broadest sense of our economy, if you look at these asset bubbles that create these crashes, it comes down to a kind of cash flow, not being enough to support the prices that those assets are being sold for. So moving on.
There we go.
All right, 3 variables. It's a little bit narcissistic for me to call them Rosh's 3 variables, but I can't help but take credit, although they're really just common sense. But just having fun, I label them Rosh's 3 variables. And it comes from all the financial modeling work that, from my personal experiences and a lot of the different valuation metrics. What I found was you can build these super sophisticated and complicated financial models, but if you just understand the underlying variables behind them, you can quickly look at the financials of an asset or a deal that's being presented to you. Now take these 3 variables and run through it on each of those deals, and boom, you got 3 metrics that you can compare. And these are in all valuations, in leverage buyouts, these are the 3 most important variables that determine the rate of return. So very simple: money in, money out, and the timing. So how much does it cost to purchase that asset? That's the money in. Definitely one of the most important variables that drive your rate of return is the purchase price. Common sense, let's not make it complicated, and let's not forget, the cheaper you can get that asset as a function of its cash flow. So now we have a way to gauge whether it's cheap or not. That by and large is one of the biggest drivers in your rate of return. So that's what we really should be looking for. However, there's other factors as well that come into play. Number 2 is money out. So how much will I be able to sell it for? So here I'll give credit to my growth investors. I may be offered a very high yield, but there might be another neighborhood that doesn't have as high of a yield in terms of the cap rate or the dividend yield, whichever way you want to look at it. But the rents are growing at a faster rate. The community is growing in population. So when I sell at the end, I'll get more money out. So that is very important, even though it comes on the back end. So money in, money out, keep it simple. Those are the first 2 variables. And money out is not just the money we get back when we sell, but we should also consider the dividends we receive in the interim, as a part of that. And that's where the 3rd variable comes into play, is the timing. So naturally, don't forget the time value of money. If I can get the money back earlier between 2 deals. So this is a hint I'm giving now to all my folks out there. We're going to have a poll coming up next. So let me give you this hint. If the money in and the money out is the same, but the timing is different, that's how we'll decide which one is a better investment. So let's check out this next question. Time value of money, which is better? So Erica, I'll let your audience go ahead and answer that poll. And again, if you want to make it, my hint to the audience is those 3 variables. So between option A and option B, I'll give a hint here. They both were bought for 100. So the money in was the same. Okay. Variable number 2 is the money out. How much money do we get back from it? I don't want to give the answer away. And then variable number 3, the timing. So which one gives us the money earlier?
Give everyone a couple more seconds on this one. Okay. So the majority said option B. Are they right?
Yes. Yes. So a very intelligent crowd. Although you can say this is an easy question, but you'd be surprised just how many folks. But let's look at the 3 variables and let's explain exactly why option B is better. So variable number 1, money in, as we've already discussed, bought for 100. That's the same on both sides. So both assets cost us $100. Now, how much money do we get out of it? In option A, clearly, first off, this asset doesn't yield any dividends to us while we're holding it. And in this case, just a year. Let's keep it simple. But when we sold it for 105. So we made $5. So we made money. It's not bad. No problems there. Option B. When we sold it, we only sold it for $2 more than we bought it. But in the interim, and here's the key, we received $3 in dividends. So technically speaking, we still made $5 in both cases. However, in option B, 3 out of those $5 we made comes in earlier. So that's actually the better investment option, which actually will make us wealthier because that IRR is going to be higher on option B. So you're going to hear everywhere, especially in the private market space and real estate, what's the IRR? What IRR are they projecting to you? Now you know the variables that drive IRR. IRR is basically looking at those 3 variables only. And so in this case, option B, internal rate of return is going to be higher. And here's a reason why, another reason why conceptually is theoretically, you receive those $3 in dividends. So you receive the profits earlier, even though it's the same dollar amount, but technically speaking, you can reinvest those $3 elsewhere after you receive them, such that by the end, option B actually yields you more than $5 because those $3 in dividends have been reinvested. And one last caveat is this is before tax implications. So there is a tax implication folks may want to consider is more often than not, your tax rate on the dividends are at a higher rate than your tax rate on capital gains. So there are certain situations where folks would actually prefer to defer their profit in capital gains rather than receive it in dividends because of the lower tax rate. But then you got to trade off that deferral. How much are you missing from reinvestment? And that's where it can get a little bit more fun or complicated depending upon your personality.
Okay. Compounding.
Oh yeah. So last point. And I'll admit I lean more towards income when it comes to the investments that I seek because it has lower risk, I believe, than growth investments. But that's why I wanted to harp on this point in particular is compounding is, and we saw this in the last example, both gave us $5 of profit, right? So my guy on the left with option A, he's saying, you know what, I'm going to go for a growth investment because I'll be able to sell it at a much higher rate than I bought it. So I'll make more money. But if I find something, okay, I can't sell it for as much as I thought, like we had in the last example in option B. But if I get more of those returns earlier, I can reinvest them. So basically, every time I get a dividend or a distribution, whatever you want to call it, from the asset, if I automatically reinvest that, then in the next successive period, technically, I have more assets generating, even if at the same yield, more cash for me than in the prior period. And then again, I reinvest all of those dividends or distributions. Now I have, again, a larger asset base in the next month. that's again producing more in dividends. And if we repeat this process over and over and over again, month after month after month over multiple years, we start compounding. And that's why we're showing this graph here, the difference. For example, at Upside Avenue, we have a dividend reinvestment program where your dividends, 7.5% in the prior year in 2021, can automatically be reinvested for you. Look at it visually on the graph, and you notice without drip is the blue line. Your investment increase linearly, excuse me. So, at a steady, more of a fixed rate. But with drip in play, automatically reinvesting all the cash flows every period after period, you'll notice the growth in the asset values that you own. It's not linear. Now, over time, it starts increasing at a faster and faster rate. In fact, it's not just me that's a geek over this. Albert Einstein himself, I'm quoting him, referred to compounding as the eighth wonder of the world. And I'll even give you an example of Warren Buffett. Naturally, he's going to come up in the conversation when we're talking about making money, because who's made the most of it in America over the last 50 years? And this is a phenomenon where he created Berkshire to be a compounding machine. If you go back to the 1950s, 1960s, when he originally started Berkshire, some of the first investments he made were in the banking space, Wells Fargo, and the insurance space, Geico. So why did he make those investments initially, early on? Is he was looking for income initially, and yes, discount to intrinsic value, and now more so, looking for growth. But back in the day when he was starting out, he wanted those dividends. So insurers and banks pay out a lot of dividends. They're more income focused. So he was receiving these dividends and reinvesting back into more stocks that he deemed appropriate every quarter and every year. And so that's why if you actually if you graphed his net worth, it follows that yellow line to where now he's at a point, and because he's been doing it so long, he's on the end of this graph where the money is just growing at exponential rates because he's just getting so much in dividends. I think it's in the billions how much he receives in dividends every year. So there's that other hidden variable there is the time. So your rate of return, in year one, year two is one thing, but if you're compounding over periods, don't forget, what effect that'll have in year 10, 12. Okay. But moving on, I could harp on that all day. So, we'll quote the guy, give him some credit. To invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. So this is Warren Buffett right here. And I love this quote because he's telling us basically hey, you don't have to be all that smart. Folks are going to come to you, especially in finance, and they're going to throw a lot of jargon and real fancy presentations. And I like what Buffett reminds us. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. So I kind of translate that as when we're looking at investing, remember it's a numeric discipline. So your emotions, yes, they are important. They can be a predictor. If you go to a certain neighborhood and you get a certain feel, it might be warning you of something. But at the end of the day, what's needed is, as he says, a sound intellectual framework, and stick to that framework. If you feel a certain way about an investment over the other, try and tie it down to the numbers in one form or the other. And that's what we're hoping this presentation helps those folks apply a framework, keeping it simple, 3 variables. We got another quote on the next slide. Nope. So Buffett actually studied under Benjamin Graham, and that's the gentleman that we're quoting here. Benjamin Graham was a finance professor at Columbia. So long ago. Buffett's like 100 years old himself. So I mean, this is a long time ago. Graham was one of the original academic pioneers in the field of finance to study the stock market and investing before it became such a common phenomenon as it is today. So I quote, "We must point out a troublesome paradox here, which is that the mathematical valuations have become most prevalent precisely in those areas where one might consider them least reliable." So he's basically saying the math and the modeling and the accounting and the finance gets most complicated, and more often than not, where it's most complicated is where they become the least reliable. So keep it simple, right? For the more dependent the valuation becomes on anticipations of the future. So now he's hinting to us, what it means to take on more risk. And the less it is tied to a figure demonstrated by past performance, the more vulnerable it becomes to possible miscalculation and serious error. So that's why I lean more towards income investing as opposed to growth. Still have growth in my portfolio, and growth is a key driver of returns. But naturally, there is inherent more risk in growth investments over income investments because growth tends to be based, well, by definition, is based on future expectations of cash flow and less demonstrated by past performance. So we got another quote, and it's the last one, folks. But this is John Burr Williams, also another academic pioneer around the time of Graham. Lesser known because his students didn't become, one of his students didn't go on to become one of the wealthiest persons in the world. But he says, investment value, so going back to valuation, defined as the present worth of future dividends. So that's just another way of saying cash flow, right? Dividends are cash flow. Or of future coupons and principal is of practical importance to every investor because it is the critical value above which he cannot go in buying or holding without added risk. So Burr Williams is reminding us, tie the price down to some metric of cash flow so that you're not overpaying for the asset. That's probably the biggest problem or investors face, especially in today's market, is overpaying for an asset. And now he's explaining to us, how do you know if you're paying for an asset?
Okay, thank you, Rosh. Definitely some great information there today. I know we wanted to get into some talks about self-directed IRAs, which is also why we're here. So with that, I think that, in my opinion, this framework is so helpful, especially for those self-directed investors, because, obviously the nature of these accounts is that they're self-directed, right, which means you're making all of your decisions on your own. You don't really have someone there, holding your hand, which is why it's so important that we provide these, educational materials. That way, there's this starting point. So we'll get into some of the weeds on what a self-directed IRA is, and also what it's not. So a self-directed IRA in its most simplest form is a way to invest in non-traditional assets. It is the retirement vehicle that allows you to do that. These types of accounts have been around since the inception of the regular IRA in 1974. And one of the biggest misconceptions that I like to point out is that self-directed IRA is not an account type. So you have available to you all the same account types that you would at a traditional brokerage. So traditional IRA, Roth IRA, a SEP, a simple, a solo K. Even health savings accounts and education savings accounts can be self-directed. Self-directed is really just the term that describes the strategy. So moving on, we have a bunch of possible investments. So really anything that is not publicly traded and anything except for life insurance and collectibles. So collectibles, fine wines, rugs, World War II fighter jets is one that we got an interesting inquiry about. But generally speaking, the list is very broad. And on future webinars, we're going to be doing parts 2 and 3 next month. on this series. We'll get into more of the, nitty gritty different types of real estate investments that you might be able to do in those conversations. But really, obviously, the list is, infinite, but there's a couple of ones that are off limits. So for things that you can't do with a self-directed IRA, that would be called prohibited transactions. All of these are put forth by the IRS, and it basically is just a transaction between the account and a disqualified person. And that we'll kind of get into in the next slide, defining those disqualified people. So in addition to yourself, obviously, per the IRS rules, you cannot personally benefit from your IRA investments. All of your IRA investments are in the name of your IRA. So it's not you as the person benefiting from it, it's your retirement account. So obviously with that, you are disqualified from your account. Also, certain familial relationships, like your husband, your wife, your mother, father, grandfather, grandmother. So we're going to go kind of up the tree and down the tree, but anything kind of outwards is okay. Siblings, aunts and uncles, friends, not off limits, but we're just going up the tree, down the tree, and spouses. Also, in addition to that list, fiduciaries of the account, business partners, people providing service to the account, or any person and or entity that may own more than half of the asset in question. So definitely good to study this list. You definitely want to avoid transacting with a disqualified person. And we'll get into some more specifics regarding real estate. So within real estate, there are a few things that you want to avoid that could trigger a prohibited transaction. Obviously, we can't contribute sweat equity. So we can't use personal funds to cover paying a plumber, paying a landscaper, doing any rehab. All of that expense needs to be paid from the IRA. Also, disqualified people, including yourself, cannot benefit from the investment. So let's say you have a rental property or a vacation property or just a house you're buying to flip and flip or fix and flip and sell. Your mother, father can't live in that house. Your spouse can't live in that house. Pretty much anyone on that disqualified person's list cannot benefit from that property. So that kind of covers the gist of it in terms of kind of what we were talking about earlier, cash flow and how all of that kind of works within the account. So essentially the investor would direct the custodian and or administrator to complete the transaction, and all of the funds associated with that investment will flow in and out of the IRA. So if we're thinking here, this little diagram that we have is the pig, which essentially just acts as your retirement account. You have money going in to the property, coming out and back into the IRA. So that's really just visually wise the best way to explain it. But all expenses need to be paid in and out of the IRA as to avoid a prohibited transaction. And just to save some time, I'm going to go through this a little bit quickly because I know that we're kind of over time. But one of the conceptual phrases that we like to use when someone is asking us about timeline is to not put your cart before the horse. So in any case, if you are interested in using your self-directed IRA to do any type of investment, the first and absolute step that you'll want to take is opening and funding your account. You cannot secure any investment personally through your IRA until those two steps have happened. So in all, we like to say that it'll take anywhere between 1 and 6 weeks for the entire process from opening the account until making your first investment. But this is generally the framework that we like to use. Opening an account takes about 1 to 2 business days. And then funding the account. You can fund the account in a number of ways. You can make a contribution. You can move cash from an existing plan, which is a transfer, or you can roll it over from an existing retirement plan, like an old 401k that you had with a previous employer, an old pension plan, an old 403b, whatever it is, those funds can be rolled over. And just to point out, it doesn't have to be an entire amount. It could be a partial amount, whatever amount that you would need to cover the investment and its expenses. And then 1 to 2 weeks for the actual investment itself. Depending on the type of investment that you're doing, whether it's a direct purchase, maybe you're doing a syndication, maybe you're investing through an LLC, all of those have different paperworks, different supporting documents that we would ask from you as the investor in order to complete the transaction. So with that, we just encourage you guys to be mindful of all of these processes and all of these procedures so that you can really stay on top of things. That way you're adhering to a specific timeline. So with that, we have gotten through today's presentation. I don't think we have any questions at this time, but I do want to encourage you guys to obviously contact us if you have any questions at all. I'm going to ask Rosh, please take some time to put your contact information into the chat box, and I'll do that for myself as well. Just make sure that when you're chatting, it says to everyone. For me, you can reach me at newaccounts@nextgenerationtrust.com or call 888-857-8058. That is our toll-free number. And you can also visit our website at www.nextgenerationtrust.com, where you can find a plethora of educational materials if you'd like to learn more about this strategy specifically, or just self-directed IRAs in general. I know, Rosh, you had a couple of things that you wanted to kind of wrap up with, so I'll let you go ahead and do that. Oh, wrong way. There we go.
Yeah, no, these SDIRA accounts are wonderful, because I think previously, with like Fidelity and Schwab, a lot of times they just limit you to public stocks, but with the SDIRAs, you can get into the private markets, and those can be quite lucrative. So we do have a guide on our website, by the way, upsideavenue.com. Highly encourage all the folks to go ahead and check it out if they want to get more information. You can also email me directly. Just a quick start guide, kind of just expanding upon some of the stuff we discussed. And then, check us out, upsideavenue.com. Next slide is don't miss part 2 and part 3. So this is part 1 of a 3-part series. And this is kind of the elementary foundation, but for the folks that want to learn more, and especially those of you that thought, okay, you got a good grasp of all this, kind of know already, we're going to get into it more depth on part 2 and 3. Second part, we're actually going to look at the financial statements of a real publicly traded REIT. We'll look at it together and kind of decipher what the valuation is it a good investment or not, just based on those financial statements. So very good 101 overview, especially for those that have not taken a formal accounting or finance class. And then lastly, part 3, May 24th, don't miss. Now, in part 1, we've got the concepts. In part 2, we've actually done a real case study on a REIT and now better understand how to read financial statements. Part 3, we're going to look at the entire multifamily sector specifically, and we'll do that through all the publicly traded REITs in the multifamily space, and even some privately held REITs. We'll compare and contrast kind of what are the different investment trends. We can use those statements to tell us, where rents are growing fastest, what has been the rate of return historically in this space, and then that can help you determine, is that a sector that you want to hone in on? It does seem to be one of the most common amongst the SDIRA custodians. So be good to know at a high level how that sector has been doing historically and where it could be going forward.
Nice. We are definitely looking forward to that and being a part of both of those conversations. So with that, that concludes our presentation. And Rosh, thank you so much for joining.
Yeah,
We are
thanks.
definitely very excited for the next two parts of this. So we hope to see everybody there and have a great day. Bye, everyone.
Bye.